The stock market is topping, and it's due for a correction by the end of Q3, and potentially a very strong correction. And that's what we're going to talk about today on Milkshakes, Markets, and Madness. And the reason we're going to talk about it is because despite all the many prognostications for a crash and for the next Great Depression and for the end of the American Empire and all the apocalyptic headlines, is that despite all of this, the stock market continues higher. So then why are we going to talk about a correction? Well, let's pull up some slides and start going through it. Because while all of that is true, and I think the apocalyptic calls for the next 2008 or the next Great Depression or the failure of the American Empire are wrong, I do think we are very much in need of and due for a correction. And so despite this, though, I'm the first to say I was very right at the beginning of the year. I was very right in Q2. And as we bounced out of April into May, I felt like I was pretty smart as well. But for the last 2 months, I don't feel very smart at all because I thought that we were going to have the correction or at least a slowdown and pullback starting late May, early June. But we haven't. And so I'm the first to hold up my hand and say, you know what? I got that wrong over the last couple of months. And in our job, listen, in this business, when you manage money, timing is everything. And if you get the timing wrong, you're wrong. But just because I've been wrong for the last 2 months I don't think I'm going to be wrong for the next couple of months. And I can cite a couple fairly recent examples. This same thing happened in June of 2024 and into early 2025 or early July 2024. I was wrong for that short period of time, but then got really correct late July, early August. Same thing happened at the end of last year. Started to think we were due for a downturn in December. Got into January, still had the same view, didn't look right. But then by the end of March, early April, it had all played out again. And I think we're moving in, and I think we have moved into another similar environment. And this chart here just shows the 4 major stock indices are basically everything's now up for the year. The Russell just a tiny bit, the Dow a little bit more, the S&P, and then the NASDAQ. But the rally out of the lows of of April has been one of the strongest, if not the strongest rallies out of a bottom of all time. And we have a number of reasons why this could continue. As the headlines state, we just continue to make new highs day after day. Even when inflationary data that comes out that in many ways should push the market lower, it continues higher. We've got the Treasury Secretary out there with gold's at its all-time high, stocks are at its all-time high, Bitcoin's at its all-time high. Asset prices have done really well. Real estate is still high. He's calling for 150 basis point cuts. So if we get that, maybe that sends stocks higher as well. And we've got BlackRock's Rick Rieder, who's kind of this legendary investor, saying this is one of the greatest investment environments he's ever seen. So with all of that going on, why have I gone on to 4 different podcasts in the last week and said we're going to get a market correction by the end of Q3? First of all, you should never make predictions. And if you do make predictions, you should certainly never put a time frame on it. So I seem to have broken both of those rules once again. And here's the reason. I just think that we have gotten way ahead of ourselves. And I'll put I'm not going to be able to go through today all the detail that I went in all these different podcasts, but I'll post the links in the description of these 4 different podcasts that I went on this last weekend where I discussed this in more detail. First, it was with Tom Luongo on his Gold, Goats, and Guns podcast. Then it was Adam Taggart and Thoughtful Money. Then it was Tyler Neville at Forward Guidance. And then Trevor Hall with Mining Stock Daily. And I had fun with all of those conversations, and I would encourage you, if you get a chance, to go check those out. And what we really did there is we really kind of summarized a lot of the stuff that I talk about and then I write about on our research site. So if you like this channel, and you haven't hit subscribe yet, please subscribe. If you like what we talk about on a weekly basis, but you want a little bit more in depth, please go over to research.santiagocapital.com, sign up, subscribe. We'd love to have you over there as well. But again, how do I know there's going to be this stock market correction? And why am I going around telling everybody that it's going to happen? How do I know? Well, the short answer is I don't know. I don't know for sure. I just think that we're going to, and I think the evidence is on my side as opposed to the side of everybody else. Now, the first thing I'll say is, can I be wrong? Of course I can be wrong. You guys know I've been wrong before. I've been right many times in my life, and I've been wrong many times in my life. And I've learned how to deal with both of those. But I feel pretty strongly that we are now due for a correction in the stock market. And it's not so much that I have a catalyst that is going to cause it. I could list you 5 different, 6 different, 7 different catalysts that over the next 6 weeks could cause the market to turn down. But before I do that, let's just take a look at some of the evidence. First of all, I'm just going to run through a bunch of charts. And there was a great chart stream both on Twitter and on Zero Hedge hosted it, and Charlie Bielo listed a bunch of them. Nautilus had a bunch of them, a couple different, but there's a lot of fantastic charts going right now. And then one of the things you guys have heard me talk about many times is the effects of passive management and how the bigger market cap companies demand that these passive strategies buy them, and that then pushes the market higher. So right now, the weighting of the top 3 holdings in the market make up 21% of the entire market cap of the market. So in other words, NVIDIA, Apple, and Microsoft, 3 companies out of 500 make up over 20% of the market cap. That is passive management personified. And this whole how do I know? Well, I don't, but this is a little similar to, I don't know if you guys have already ever heard of Louis C.K., but he's a comedian. And he used to do this bit that was called, of course, but maybe. And one of the examples, and he had a whole list of them. The one I remember was like, he's like, the whole thing with like these nut allergies, right? It's horrible that, some people can get exposed to a peanut, and something as simple as that can cause them great harm. And I would never want that to happen. He says, I have a niece that is allergic to peanuts, and I would be devastated if anything ever happened to him. So of course, I want to keep that from happening. And he says, however, but, if we just exposed everybody to all the nuts, maybe in a year we wouldn't have to worry about this anymore. So this whole slide deck is a little bit about like, of course, but maybe. I understand all the reasons why the stock market could go higher. I understand all the argument says, oh, it's different this time. Oh, you're just not thinking about this. Oh, the government's never going to stop printing money. Oh, nothing stops this train. Oh, this, and this, and this. There's plenty of arguments you can make for why the stock market's going to go higher. But maybe we should pay attention to some of these signals. 21% of the entire market in 3 companies. That's rather concentrated. That alone means it's exposed to risk. Or what if we just up it from the top 3 to the top 10? Now it's 38% of the market. So again, if 3 owning 20% of the market wasn't crazy enough, 10 making up 38% of the market, over a third of the entire market, is equally insane. Then let's look at the MAG7. So we'll switch from 3 and 10 down to just 7. Okay. So if you look at this, you can see the net income growth of the S&P 500 and the MAG7. And you can see over the last 1.5 to 2 years, growth has been falling. But even though it's been falling, the MAG7 still dramatically outperforms the other 493 and the S&P 500 as a whole. So again, you see a lot of you see slowing growth and you see concentration. What do you think happens if some assets or some money starts to flow out of those top 7 stocks? Things could get ugly pretty quickly. Or what if we look at the market cap weightings of the sectors? Now we see that this is now the tech related sector is now a bigger percent of the overall market cap than it was during the dot-com bubble. Now, does that automatically mean that we're going to have another dot-com crash? No, it doesn't mean that. It absolutely does not mean that. But it just means that's the type of environment that we're in, and it's happened before. And that's a red flag that you should plant and just at least keep your eye on. Or if we look at the price to peak earnings ratio, it's now back as high as it's been any time in the last 25 years. Again, on its own, does that mean that we're due for a crash? No, it doesn't mean we're due for a crash. It just means we're in the environment where it wouldn't be shocking if things turn down. Or what if we look at the price to sales? Never been higher, right? So again, we're starting to get a lot of flags. Any of these on their own is kind of curious and interesting, but not necessarily cause for alarm. But when they start to stack up one after the other, it's time to start paying attention. Or what if we switch out of equities and we move to high yield and we look at the credit markets? Well, credit spreads have never been tighter. And for those who aren't familiar with the way this works, if credit spreads are tight, that means that there's no risk in the credit market and everybody thinks everything is fine. In other words, companies don't have to pay that much more to get financing than the benchmark treasuries off of which it's funded. So again, it just typically, if there was risk in the market, you would see these spreads widening, and instead it's at near 30-year lows. Or what if we look at the price to book value? Again, just going back to valuations. It's the highest it's been in 25 years. On its own, is it a guarantee? Nope, it's not. But something to keep an eye on. And it's just one more flag that has been planted. Or what if we look at, again, we get back to the tech sector, to the S&P 500. We looked at this a few minutes ago on another slide shown a different way, but it just shows how extreme the tech sector's performance has influenced the overall market. And again, it speaks to concentration in the market. Or what if we look at the equity positioning? Here we see the positioning here shows 89% on systematic equities. So again, it's not the all-time high, but it's certainly not the low. And it's the polar opposite of where it was in April just 6 months ago. Or what if we look at the difference between momentum plays and profitability plays? In other words, you take stocks that are trading on momentum rather than how profitable they are, and you divide them on stocks that aren't trading on momentum but are more profitable, and you see momentum is dramatically outperforming profitability. And what happens to momentum when it no longer exists? In other words, momentum goes in both directions. It doesn't just go higher, it goes lower. And when momentum goes lower, it's something you better have already been prepared for, because you're going to be very hard getting in front of it if it starts to turn down and you were not ready. It goes back to the old, stairs up and elevator down thing. Okay, let's look at another thing. Let's look at the CTAs, commodity trading. I can't even remember what the A stands for. Anyway, commodity trading accounts or something like that. But long story short, this is a trend following strategy. It means they follow what everybody else is doing. Again, it's kind of a momentum play. So if the trend following strategy is 95% exposure, what does that say about everybody else that they're following? They are by definition behind the curve, or at least just right with the curve, but they're not leading the curve. So if they're at 95%, it by definition means the overall market is as well. Everybody is positioned the same. Everybody's long. And not only is everybody long, everybody is mega long. So then we get into seasonals, right? And we look at the 4-year election cycle. We're entering into the time period where markets typically, on average, go sideways to down. Now, again, does this on its own mean that September is going to be down? Nope. But it's a pretty interesting data point when everything else is lined up the way it is. Or what if we look at annualized volatility and look at the seasonalities there? Well, we already said the VIX is at 15. And here we are going into what is typically the most volatile season of the year. And listen, I don't know why this is, but if you look back historically, stock market and financial market crises or turndowns or however, events, for whatever reason, they oftentimes happen in the fall. And, you know, we're in late summer. It's going to be September here pretty soon. And not only are we entering into what is typically the most volatile time period of the year, but we've got, you know, easily a half a dozen and perhaps a full dozen of potential catalysts on deck that could easily keep the market from grinding higher or rallying higher as it has been doing. And then we look at the put call ratio. Now, this isn't extreme, but it, you know, it's certainly not a bullish signal, or I mean, it's certainly not showing that everybody's buying puts. It's certainly not. It's certainly showing that not everybody's out there buying puts. You know, maybe not everybody's buying calls, but they're certainly not fearful based on the way the put call ratio works. And then we talked about the VIX. The VIX is at 15. You know, it just does not get that much lower than that. Now, can it get lower? Of course it can. Has it gotten lower? Of course it has. Does it stay down there for very long? Not usually. And when it does spike, look how high it can spike and look how quickly it can do. That is not something that you can handle after it's already happened. That's something you have to be prepared for ahead of time. Now, again, does the VIX all on its own, being at 15, mean we're going to have a crash? No. But everything is lined up. Everybody's positioned the same. Sentiment is extreme, positioning extreme, concentration is extreme. There's no fear in the market, and we're entering the typically riskiest time period of the year. Now, let's look at a couple markets. And you guys have seen me point these out before. And this is the S&P 500. And you can see that over the summer, it got in. The middle is the RSI. So the top is the price chart. The middle is the relative strength, and the bottom is the stochastics. Now you can see the orange box that I've highlighted over the summer. Both the stochastics and the momentum got into very much overbought conditions. Now price came down a little bit, and as such, the relative strength sold off a little bit, and the relative strength has tried to turn back higher as price has kind of turned back higher, and now it hasn't gotten into new highs, or it's kind of right at new highs. But you can see at the bottom, despite relative strength trying to turn back up, the momentum is still headed down. Now, ideally, a lot of times people will not try to short the market when these things are at their very highs, because they'll say, wait for the market to break and retest and then do it. And so what we have here is we have both got into overbought territories, price turned down, it's now bounced back up, trying to make a new high, but the momentum is no longer there. So you have a divergence between price and momentum. And typically, not always, not a guarantee, but typically that signals that price is going to turn lower as well. So again, all on its own, not important. But when you consider the 15 or 20 charts I've shown you already, and you combine it with this, and then you realize we're going into the riskiest time of the year, and you look around the world and you think of all of the potential catalysts, it's something to think about. Now let's look at the NASDAQ. Similar thing. It actually has made a new high. So the price turned down a little bit at the very end of July. It's bounced since, and it's been able to push through its all-time high. Now, what I find interesting here is the Dow has not been able to push to an all-time high. The S&P is kind of right at its all-time high, but it's really only the NASDAQ that's been able to push through. The reason the NASDAQ has been able to push through is the effects of the passive management that we've talked about. And it's the effect of those either 3 stocks or 7 stocks or 10 stocks that are all concentrated that we talked about a little bit higher. But the momentum is kind of gone. And so they really need to get the momentum turned back up if this is going to continue. The analogy I've used is if you're riding a bike really fast and you start to go up a hill, that speed, that momentum that you have can help carry you to the top of the hill. And if you don't stop and you just keep going, perhaps it's not that hard to reach the top of the hill. But if you stop 3/4 of the way up to take a drink of water or fix the tire or just take a rest, and then you try to start riding that bike again on a hill, 3/4 up it all the way, and you still have to get to the top, it's a lot harder to make it to the top. And the momentum that has turned down is indicating that's where we're at on the hill. It's not impossible, doesn't mean it can happen, and it doesn't guarantee a crash. It just means there's some challenges to continue higher. Okay, now let's look at semiconductors because we have the same thing. And the semiconductors, I think, could play a huge role in this because they are part of the MAG7. NVIDIA has basically gone straight up and higher. And NVIDIA's effect on the overall market is essentially, I mean, without being too hyperbolic about it, it's basically becoming too big to fail. It's almost like a systematically important bank at this point. Now, that doesn't mean it won't fail. It doesn't mean that it won't roll over. It doesn't mean there can't be pain. But that is how big of an effect NVIDIA has on the market now. And so do some of the other semiconductor companies. And their price has rolled over. It's popped back a little bit, not back at its high. And the momentum, though, is gone. If semiconductors turn down, they are going to take the market with it. Now, how far it goes, that's open for discussion. I want to be clear. I'm not predicting a 1929 style crash. I'm not even predicting another 2008 style crash, but it wouldn't take a whole lot to have a 10 or a 15% pullback. That would actually be very healthy, very normal, and actually might be, I don't know, might be a good time to actually start getting long. We'll have to wait and see. But buying stuff right here, right now, just doesn't make sense to me. And I think we are due for a crash. Now, I think there's a lot of people out there calling for equities to continue higher, bull market, US exceptionalism, all of that stuff. And I think there's a lot of people out there who are apocalyptically negative, saying we're going into another big crash. I want to be clear. I'm not in either one of those camps. I'm somewhere in the middle. I think we're going to have a correction. I think it's going to come fairly soon. I would be surprised if we get out of Q3 without it happening by the end of Q3. But as of now, and this could change, but as of now, I would view that as an opportunity to probably reposition to go back higher. Now we'll have to wait and see whether it even happens, and we'll have to wait and see why it happens if it does happen. But as of right now, I don't know too many other people who have the same outlook that I'm currently expressing. I'm not saying they don't exist, but I've seen a lot of people really bullish. I've seen a lot of people really negative, but I haven't seen too many nuanced views regarding short-term and long-term. Now, I kind of hesitate to even post this chart, but it just goes along with everything. It's just something to be aware of. This is an overlay of 2008 versus 2025. Now, this doesn't necessarily mean we're going to have another 2008, but it just shows you, I mean, the pattern is there. Pattern recognition is important, and the pattern is there. So it's just one other thing to consider when you look at the other 20 things I've already shown you. So how far could we actually go? Okay, so, well, this is the S&P 500. You can see there's a couple gaps here. And I guess the first drawdown would be, like 7 to 8%. That could easily happen, go down and fill that gap. And then the second gap is, I think, down around 11 or 12%. And then there's a third gap all the way down, down around 18%, I think. But, I think these could easily happen. Whether they will or not, I don't know. I think I said something similar back at the beginning of June. I've already had said that didn't play out, but I think the factors which could cause that to happen now are even more strong than they were then. If we look at the NASDAQ, the NASDAQ, I think it's also similar. The first one's around 10. I think this is a little small. I can't read it. I think it's around 18 or 19. But listen, these could easily come down, and these gaps could get filled. And then the last one that I want to look at is the semiconductors, because I think the semiconductors could potentially have a pretty strong one. And that's over a 20% drawdown to go back down and fill that channel or fill that gap. Now, again, these aren't necessarily specific predictions, but if you're asking me what kind of a correction level I think could happen, I think these levels of a correction could happen, and it wouldn't even be that serious, especially considering how high we are and considering how far we've come since April, and especially how far we've come over the last couple of years. In many ways, I would argue that if something like this did happen over the next couple of months, it would actually be healthy for the market and allow it to build a base and then, gain some structures to where the momentum going forward from there, I think, would be more plausible and potentially more long lasting. But I think with the high concentration that we have right now in, just a few names and how far they've pushed it, I think the market is very, very fragile, to say the least. Now, I'm going to say again, I'm not necessarily telling everybody that they should go out and short the market, that they should go buy puts, that they should sell everything. You have to make that determination for yourself. I'm just saying this is the type of an environment in which a correction can happen. And the last 2 times that we had this setup, I was early, but I was ultimately right. And it played out in July of last year and March and April of this year. So the last 2 slides I'm going to show you is I actually just pulled these slides from an episode we did. I think it was back in April after we'd had it was April. It was either April or May after we'd had the big sell-off in April. And I was showing you some of the puts that we had looked at and owned. And an example of things you might consider. Now, again, I'm not telling you to do this, but at the time, I had shown that in January, you could have bought a put, I think like 1% out of the money through the end of June, and it would have cost like $16 or $17 for that put. And that was around 2.5% of the cost of the portfolio. So in other words, for 2.5% of your portfolio, you could have protected it basically all the way out through June 30th. Well, that same put right now today costs almost the exact same thing through the end of December. Now, again, I don't think it's going to take to the end of December for a correction to happen. And I think it will actually happen. I've said it. I think it's going to happen sometime in September. So it would be even cheaper to only protect through the end of September. But if you went out to December right now, it would cost about the same thing. Now, in April, what happened is that put went from $17 to over $100. So it was over a 7x return. And that 7x return helped protect the portfolio that went down during that time. Now, again, and not only that, but VIX was priced similarly. You had a lot of similar, and everybody was bullish, everybody was positioned the same. So we really have a very similar environment again now. You could even argue it's a little bit more fragile now just because of the concentration has gotten even higher. But the point, again, you have to determine for yourself whether this is right or not. But the way we manage money and the way we've been able to survive in this business for 25 years is always being prepared for the worst case scenario, even if the worst case scenario doesn't come. The worst thing that happens is that your insurance doesn't pay off. And this is the last slide I'll show you. Again, it just kind of shows you the time to buy insurance is when nobody else wants it. It's never a guarantee that it's going to pay off, but I would much rather want to be buying insurance when the VIX is really low than buying puts when it's really, really high. And so if it's something that you're interested in taking a look at, that would be the time to do so. Oh, you know what? I just noticed as I'm looking at this chart, the black line is the S&P and the pink line is the VIX. The color on the charts on the labels up top are wrong, but the black line is the S&P. The pink line is the VIX. Anyway, that's it for this week. Hope you guys have a great week. We'll be back next week. A lot going on. We had Trump in Alaska. This coming week, we've got Jay Powell at Jackson Hole. The week after that, we're going to have at the end of the following week, we're going to have Labor Day. And then after that, we're going to be only a couple weeks away from another Fed meeting. So there's a lot of stuff going on over the next 6 weeks. Hope you're prepared for it. Talk to you later. Bye.